Good morning. Good morning, guys. How we doing?
Good morning.
Good morning. How are you?
I'm doing good. Welcome back. How was your spring break?
It was great.
It's good. Now we got about 5 more weeks of the semester remaining. So give it your best for the next 5 weeks. And do well on the finals and the next exam. Okay. The last time we were here, the last 2 times, we talked about chapter 4 and chapter 5. Today we will talk about chapter 6. Now, next Tuesday, I'm not going to be available. I have to have my second COVID-19 shot. And these things they give you by appointment, so I have to be there when they're ready to give it to us. So after today, the next time we're going to meet will be on Thursday. But you're going to have work to do. You're going to have your homework to do on Tuesday, so you want to get that done. Okay. So today we are going to talk about chapter 6. And let me just share screen. Let me just share my screen. Okay, so here is our chapter 6. Let me make sure I'm on recording. I'm going to exit. Oh, yes, I'm recording. Good. Now, chapter 6, we're going to talk about audit responsibilities and audit objectives. In an audit engagement, once we undertake to do the audit, we have certain responsibilities. Our objective in the audit is to determine if the financial statement are stated in accordance with GAAP. And if it is, then we're going to issue an audit report. Now, in conducting the audit, our responsibility is to conduct the audit in accordance with generally accepted auditing standards. So, generally accepted auditing standards are the minimal level of performance in an audit engagement. So our responsibility is not to just meet that minimum level of performance, but to exceed those minimum level of performance. And at the end of the process, we will issue a report. And we talk about the different types of report that we issue in chapter 3. So what are some of the things we're going to cover in this chapter? Question? Any questions before we go on anything that we're doing? Yeah. What are some of the things we're going to talk about? What are the learning objectives? We're going to explain the objectives of conducting an audit of financial statement and an audit of internal control. So not only are we doing audits of financial statement, we're doing audits of internal control also for some entity. Any public companies or all public company will have an audit of financial statement as well as an audit of internal control. Non-public companies are not required to have an audit of internal control. 2, distinguish management responsibility for the financial statement and internal control from the auditor responsibility for verifying the financial statement and the effectiveness of internal control. Management is generally primarily responsible for the financial statement and internal control. It is their financial statement. Their staff is preparing the financial statement. They're the one that are implementing the policies and the procedures of the organization. So they are primarily responsible. The auditor responsibility is to review what they're doing and to form an opinion. That examination that the auditor is doing is conducted in accordance with generally accepted auditing standards. Explain the auditor responsibility for discovering material misstatement due to fraud or errors and the need to maintain professional skepticism when conducting the audit. Now, first of all, let's distinguish fraud from errors. Fraud are intentional misstatement. Errors are unintentional misstatement. So fraud are more difficult to discover than for error. Because if you commit a fraud, you will cover it up. You're aware what happened and you'll try to cover it up. If you made an error, you're not going to be aware of what happened. And you're not going to try to cover it up. So fraud are intentional misstatement. Errors are unintentional misstatement. And the need to maintain professional skepticism. What is professional skepticism? Professional skepticism is that when you're conducting the engagement, you're aware of the type of errors and the type of fraud that can be conducted. And the back of the mind, in your mind, you're looking to see if they are happening. Think of this. Think if we go back to before COVID-19, and we're in the classroom, and I'm giving an exam. When I give my exam to the class, I will sit in front there, and I will observe the exam. I will observe the exam with a degree of professional skepticism. I'll be aware of the fact that students can do cooperative work, and that they probably will if you allow them. So I will try to mitigate the amount of cooperative work, if any, that is being conducted. So I will look at the student, I'll let them know that I'm looking at them. I'll let them know that I'm observing what they're doing. Why? Because when someone is observing, it prevents you from doing certain things. Likewise, when we're doing the audit, we're going to observe the surroundings of the audit. We're going to observe what's going on. We're going to be assertive. We're going to be aware. We're going to maintain an awareness of what's going on so that we could detect fraud and error. 4, classify transaction account balance into financial statement cycles and identify benefits of a cycle approach to segmenting the audit. When we conduct the audit, we use the cycle approach. think of this, when you're doing financial statement, when you're doing financial accounting, you talk about these cycles. The cash cycle. You use the cash to buy goods and services, you sell the goods and services, and it gives you accounts receivable. You collect the accounts receivable and it comes back to cash. That's the cash cycle. You got a cash cycle, you got a purchase and acquisition cycle, etc., etc. We're not going to talk a lot about cycle in this class, but you must know what they are. 5, describe why auditor obtain a combination of assurance by auditing classes of transaction and imbalances in accounts, including presentation and disclosure. Why do we examine a class of transaction rather than one transaction? If we're looking at cash and we're examining cash, we must be concerned with all the transaction affecting cash, because any one transaction could cause the balance to be incorrect. So we must be concerned with cash receipts, we must be concerned with cash disbursement, we must be concerned with adjustment to cash, to make sure that all these entries are proper. Distinguish among the 3 categories of management assertion about financial statement. We're going to talk about that later, what they are. Okay. What assertion management are making when they give us a set of financial statement. Number 7, we'll list the 6 general transaction-related audit objective to management assertion. For classes of transaction, we're going to talk how they are related, how the transaction-related audit objectives are in tune with management assertion. Number 8, we're going to link the 8 balance-related audit objective to management assertion for account balances. Similar things. When we talk about balance-related audit objective, we're talking about the balance sheet. When we talk about transaction-related audit objective, we talk about the income statement. 9, we're going to link the full presentation and disclosure audit objective to management assertion for presentation and disclosure. We're going to talk about what they are. What are these 4 items? And how they are linked to management assertion. And 10, we'll explain the relationship between audit objectives and the accumulation of audit evidence. So let's dive in. First item, explain the objectives of conducting an audit of financial statement and an audit of internal control. What is the auditor objectives in conducting an audit? The purpose of an audit is to provide financial statement users with an opinion by an auditor on whether the financial statements are presented fairly in all material respect in accordance with applicable financial accounting framework. So what are we saying here? We have the auditor and we have the financial statement users. The financial statement users are management, creditors, investors, stockholders, etc. Management generally prepare the financial statement, but management is not objective. Management wants to show that their company is doing good. We need the auditor, who is a third party, to look at these financial statements and to determine if these financial statements are presented fairly in all material respect in accordance with applicable financial accounting framework. What are the financial accounting framework? Basically, they're saying we're looking at these financial statements to determine if they are presented in accordance with generally accepted accounting principles. All the rules you study in Accounting 101, 102, 201, 202, 203, and 301. So we're looking at these, we're examining these financial statements to make sure that they are prepared in accordance with GAAP. Steps in developing the audit objective. They list here 5 steps. 1, we'll understand the objectives and responsibility for the audit. 2, we'll divide the financial statements into the various cycles. You break it up into smaller pieces, it's easier to manage. 3, we're going to know what management assertion about the financial statements are. We're going to talk about that shortly. 4, we're going to know our general audit objectives for classes of transaction, accounts, and disclosure. We are also going to talk about that shortly. And we'll know specific audit objectives for classes of transaction, accounts, and disclosure, which we're going to talk about shortly. So, in a nutshell, the auditor responsibility is to determine if the financial statement are presented in accordance with the objective. What are the objectives? Generally accepted accounting principles. In making that determination, the auditor has to conduct an audit in accordance with generally accepted auditing standards. Number 2, distinguish management responsibility for the financial statement and internal control from the auditor responsibility for verifying the financial statement and effectiveness of internal control. Let me make sure my speakers are on. Can you guys hear me clearly?
Yes.
Yes.
Good, thanks. Management responsibility. Management is primarily responsible for the financial statement and the system of internal control. In chapter 11 and 12, we're going to dedicate those 2 chapters to talk about the system of internal control, what it is, how it functions, how we design it. The Sarbanes-Oxley Act increases management responsibility for financial statement. Management must issue a report. And next we have a management report of how they're delegating their duties and their financial responsibilities. Management must sign off on the financial statement. The CFO and the CEO must certify the financial statement, not only the accountant. The CEO and CFO must certify quarterly and annual financial statements submitted to the SEC. The Sarbanes-Oxley Act provides for criminal penalties for anyone who knowingly falsely certified a statement. Knowingly falsely certified a statement. There's a word for that, and that's what we call fraud. Knowing that you're doing something incorrect with the intent to deceive is fraud. So if management is involved in fraud, they can go on a nice vacation to an island that we do not call Jamaica. Explain the auditor responsibility for discovering material misstatement due to fraud or errors, and the need to maintain professional skepticism when conducting the audit. Again, to recap, fraud are intentional misstatement. Errors are unintentional misstatement. Professional skepticism, you're conducting the audit with a sense of awareness that fraud and errors can occur. You actively look to see if there are any indication of fraud or errors. Objectives of the auditor. The auditor must obtain reasonable assurance that the financial statements are free of material error. And if they obtain that assurance, then they will give an opinion on the financial statement within the applicable reporting framework. They report on the financial statement, which means that they are communicated per audit standard. They're communicating to the public that the financial statement is stated in accordance with GAAP. So if the auditor gives an unqualified opinion on the financial statement, it means that the financial statement in all material respect are stated in accordance with GAAP. What do we mean by all material respect? It means that there could be errors, there could be misstatement, but those errors or misstatement are inconsequential. They will not affect the user judgment. Auditor responsibility. The auditor must obtain reasonable assurance for errors and fraud. The auditor is concerned with material misstatement, and they conduct the audit with a degree of professional skepticism to detect errors, fraud, or fraudulent reporting. What is fraudulent reporting versus theft of asset? Fraudulent financial reporting is generally done by management when they will willfully mistake the financial statement. Why? The company is doing poorly. Management want to show that the company is doing well. So they'll willfully misstate the financial statement. That's fraudulent financial reporting. Theft of asset, we all know what theft of asset is. We steal assets from the company. It can be done by employees. It can also be done by management. And it is illegal to do. We could go to jail for stealing assets. So don't go to York College and take the computers. They're not there for you to take home. They're there for you to use and leave it there for others to use. I'll be back. Come. You gonna say hello? Come. Look, I'm teaching my class. Say hello. My granddaughter insists on showing me a brick she found outside. Say hello. Show them the brick you got. Look. Okay, now you're gonna go to Nana teach. You're gonna go to Nana for Nana teach. Okay? All right. You say hello? Say bye. Say bye. Good girl. Go to my kiss. Good girl. Sorry, guys, a little family time with the love of my life. Okay. Auditor responsibility for considered laws and regulations. You got laws and regulations are divided into two categories. One are direct effect and the other is indirect effect. What do we mean by that? Certain laws and regulations, by the nature of them, the auditor will be familiar with them. Think of this. If the client is breaking tax laws, we know what tax laws are. We need to evaluate and detect that. Those are direct effect illegal acts. The auditor responsibility for those types of illegal acts is the same as it is for errors and fraud. Then there are indirect effect illegal acts. These acts, we may not even know what they are. We may not even know if they're violated. Think of Environmental Protection Agency's laws. Do we know if they're violated? We don't know what they are. I'm teaching at York College for 30 years now. I don't know what are some of the EPA requirements. But every so often you hear that they have to eradicate mold or do something else somewhere because of the EPA. Right? So some laws are in direct with the scope of what the auditor does, and the auditor is aware of them and can determine if they are violated. Others are outside of the scope of the auditor work, and the auditor is not even going to be aware of them. And the auditor will give no assurance. When we conduct an audit, we give no assurance on these environmental laws because we don't know what they are. But we do give assurance on the tax laws because we should know what they are if we are accountants and auditors. We should know if the tax laws are being violated. The auditor responsibility to consider laws and regulation. Have that in two categories. The first category is if the auditor suspects. The auditor suspects that some laws may be violated. What does the auditor do? Well, if they suspect, they have to act on that suspicion to see if their suspicion is correct or not. If the suspicion is not correct, they move on to the normal audit procedure. If the suspicion is correct, then they will have to do something a little different. So if the auditor suspect that the law is violated, the auditor will inquire of management. They will ask management. The auditor will consult with the client counsel or specialist because they're the one that will know if the laws are violated. The legal counsel will be the one that will be representing them. The auditor may also consider accumulating additional evidence to determine if his or her suspicions is actually correct. Now, if after going through that process, the auditor knows that there's an illegal act that is material, the auditor will consider the effect on the financial statement. The auditor will consider effect on relationship with management. If management knows that the laws was violated and they do nothing about it, it means that management is not ethical. It means that management might be in part for a piece of the action and there may be other laws that are violated. So you want to consider, do I want to work with this type of management? Do I put a lot of faith in what they says if they are condoning illegal act? They want to communicate with the audit committee or equivalent. The audit committee is an intermediary, as we talked about in chapter 1 or 2. It's an intermediary between management and the client. So you will be reporting your findings to them. You want to let them know so that they could have a serious discussion with the client about what's going on. Classify transaction account balances into financial statement cycle and identify benefits of cycle approach to segmenting the audit. We talked about financial statement cycle. I'm not going to deal in depth with this. Audits are performed by dividing the financial statement into smaller segments or components. And then we audit each cycle. What are the components? We have the sales cycle, the cash receipts, the acquisition of goods and services, the cash disbursement, the payroll services and disbursement, the allocation and adjustment. And you did all this in your financial accounting. So you could just review it. Relationship among transaction cycle. We got the general cash cycle, we got a capital acquisition and repayment cycle, the sales and collection cycle, the acquisition and payment cycle, the payroll and personnel cycle, the inventory and warehouse cycle. Five, why the auditor obtain a combination of assurances by auditing classes of transaction and ending balances in account, including presentation and disclosure. Why do we audit classes of transaction? They give you an example of accounts receivable. Accounts receivable, the balance in accounts receivable is affected by sales, is affected by cash receipts, it's affected by sales return allowances, and it's affected by charge-off on uncollectible account. If we want to determine the correct ending balance, we have to examine each of these classes of transactions and their effects on accounts receivable. We cannot just examine sales alone or cash receipts alone. We have to examine all the classes of transaction that affect the accounts receivable. Distinguish among the three categories of management assertion about financial information. Management assertion. What are their assertions? When you go to the client, they give you a set of financial statements. Say, here, this is our financial statement. What are some of the assertions they are making? They're making certain assertions about classes of transaction and event for the period under audit. Number one, we're talking about the income statement, the transaction affecting the income statement. They're making assertions about account balances at period end. Here we're talking about the balance sheet. And they're also making assertions about presentation and disclosure. We're talking about all the financial statements along with the disclosure required by generally accepted accounting principles. Management assertion for each category of assertions. Transaction and event. We go to the client and they give you the financial statement. The financial statement shows sales of $5 million. They are making this assertion that those sales occurred, the transaction occurred, giving rise to that $5 million of sales. They're making that an assertion that that financial statement is complete. All the transactions that should be included are included. They're making the assertion that that financial statement is accurate, that all the calculations are proper of sales, that all the calculations of expenses, including depreciation, are proper. They're making the assertion that is proper classification between cost of goods sold, selling, and general administrative expenses. They're also making the assertion that is a proper cutoff. At the year end, all the transactions that completed before December 31st are included. Now, how we determine what transactions are included at December 31st? This all goes back to your shipping term. In accounting 102, you talk 101, I think, you talk about shipping term. FOB destination, right? FOB destination, free on board destination, mean that the seller is responsible for the goods until it reaches the client destination or the client warehouse. Which means the sale doesn't occur until the goods is received by the client. So if you're using free on board destination, the cutoff will be, we will make sure that the goods is received by the client before December 31st, before we include them in sales. Then we have the second category, which is free on board shipping point. If the client is using free on board shipping point, then the sale occur as soon as the goods leave the client warehouse. Now, this is extremely important. There's a public company up in New York, Ireland and New York, Computer Associates. They got into trouble with this. And the chief financial officer, a guy who I knew personally, well, we're not friends or anything, I just knew him because I saw him at the accounting shows and conference. I knew him when he just started out and was developing this product, and he became a multimillionaire. He ended up in prison because he was the chief financial officer for the company when the SEC were investigating their cutoff on their revenue cycle. And the SEC determined that their cutoff was improper. Now, Computer Associates at the time was owned by Charles Wang and Sanjay Kumar. Charles Wang is also the owner of the New York Islanders. So he's still around doing things, but Sanjay Kumar went to prison and he had to declare bankruptcy because they cannot hold on to all the assets he had. So you could go from a millionaire to be a pauper by just doing something fishy, right? And I'm not too sure about how fishy what he did was fishy, but yes, he determined that it was. So it's important that to use a proper cutoff. Account balances. Account balances, we're looking at the balance sheet. You go to the client. Yes, baby, Nana is teaching. You go to the client place of business and the client gives you a balance sheet. In that balance sheet, they're making certain assertions. All the assets listed on that balance sheet, they're making the assertion that those assets actually exist. If they have cash 100,000, it means that somewhere in the bank account it's $100,000 of cash. Now, when we talk about cash, we talk about cash and cash equivalent. Cash equivalent include all highly liquid short-term investment with an original maturity date of 90 days or less. So they're saying if they have cash of $100,000, they're saying that they have actual cash along with short-term investment that's amount to $100,000. Completeness. The assets are completed. All the assets that should be included are included. Valuation and allocation. The assets are properly valued in accordance with GAAP. Well, cash is cash. Accounts receivable have to be valued. That is not net realizable value, which means that there has to be a proper allocation for uncollectible accounts. Inventory have to be valued at the lower of cost of market. Property, plant, and equipment have to be valued at its historical cost, less accumulated depreciation. So there must be a proper allocation to depreciation expense. Rights and obligation. All those assets, the client have rights to them. The client owns them. Obligation, all the liabilities issued there are obligations of the client. They are obligated to pay them. Presentation and disclosure. Occurrence and rights and obligations. Occurrence. All the transactions occur. All the assets and liabilities, the client have rights or obligation. Rights to those assets or obligations for those liabilities. The financial statements are complete. Everything that should be included are included. Accuracy and valuation. They're accurate and the accounts are properly valued in accordance with GAAP, as I just discussed. Classification and understandability. The income statement is properly classified. The balance sheet is properly classified into current and non-current, and it's understandable for someone to read it. They're able to understand it when they read it. So these are the management assertions for each category of assertions. PCAOB assertions: existence and occurrence, completeness, valuation, allocation, rights and obligation, presentation, and disclosure. PCAOB stands for Public Company Accounting Oversight Board. Every public company is responsible to be a member of the PCAOB, and the PCAOB kind of dictate the accounting requirement. Link the 6 general transaction-related audit objectives to management assertion for classes of transaction. Same like I discussed, occurrence, recorded transaction exists. Here we're looking at the income statement. Completeness, existing transaction are recorded. Accuracy, recorded transaction are stated at the correct amount. Posting and summarization, transactions are included in the master files and are correctly summarized. Classification, transactions are properly classified. Timing, which you have to do cutoff, transactions are recorded on the correct dates. And again, it has to do with your shipping term, FOB shipping point or FOB destination, that determine when the transaction is completed and when it should be recorded. And they give you an example of Hillsbury hardware store. You could look through that. 8, we are linking the 8th general balance related audit objective to management assertion for account balances. Here we're looking at the balance sheet. Existence, amounts included exist. Completeness, existing amounts are included. Accuracy, accounts included are stated at the correct amount, and then it depends on how we value them, right? Accounts receivable net realizable value. Inventory, lower cost of market. Property, plant, and equipment. Historical cost, less accumulated depreciation. Classification, amount are properly classified into current and non-current. Cut-off, transaction are recorded in the proper period. And detailed tie-in. What is detailed tie-in? We have the account balances for accounts receivable in the controlling account. We have accounts payable controlling account. Then we have a detail of how much is owed from each customer. That detail, schedule of accounts receivable, I have to tie into the controlling account. Likewise, the detail for accounts payable have to tie into the accounts payable controlling account. Realizable value, our assets are recorded at estimated realizable value. Rights and obligation, asset must be owned, liability must be the obligation of the client. And again, they give you an example of Hillsbury hardware. 9, we're going to link the for presentation and disclosure related audit objective to management assertion for presentation and disclosure. And they give you an example of Hillsbury hardware. And they give you the specific presentation and disclosure. Notes payable are described in the footnotes. All the disclosure that are required by generally accepted accounting principles. Now, disclosures are important. The footnotes are an integral part of the financial statement. And the majority of the time when accountants are sued, they're not sued because something was omitted in the body of the financial statement. They're sued because something is omitted from the footnotes. So we have to be careful about those footnotes. Explain the relationship between audit objectives and the accumulation of audit evidence. The standard of fieldwork, the auditor must obtain sufficient appropriate evidence to support all management assertion in the financial statement. The standard of fieldwork call for that. So we need to go and obtain enough evidence to form our opinion. Now, how we determine if we have enough evidence? It's all based on the auditor judgment. So as auditors, we must possess good judgment. The audit process has 4 specific phases. Part 1, we plan and design the audit approach. Part 2, we perform tests of control and substantive tests of transaction. Part 3, we perform analytical procedure and tests of detailed balances. Part 4, we complete the audit and issue the audit report. Now we talk about issuing the audit report in chapter 3, but the other 3 parts we're going to talk about in the chapters to follow. And that will conclude our course after we finish talking about all of that. So this concludes chapter 6. Next Thursday, we'll talk about chapter 7. Tuesday, I'm not going to be here because I have to take my second dose of Pfizer vaccination to keep me safe. And I'm going to go back to I'm going to stop sharing my screen. And you could unmute your mic if you have any questions or discussion. Please unmute your mic so I could hear you.
Professor, okay, when you were talking about fraud, like right now, like people are doing the PPP application, right?
Yeah.
So like someone, let's say someone who doesn't own like a business and you apply for the PPP and you get the loan.
No, that's fraud, and you can go to jail for that. Now, there's a woman that applied for, I don't forget how much $1 million of PPP loan. Then she left the country. She claimed that she had a non-for-profit organization, and upon receiving the money, she left the country and she's in Canada. And the FBI and the federal government are going after her. She's going to end up in jail.
But
sorry.
Sorry. They said when the amount is less than 2 million, like they will not investigate.
Not quite. Not quite. Any instances of fraud, they're going to investigate. Now, if the amount is less than 2 million, they may not focus so much on it. But if somebody calls up, this is how fraud are detected. Let's say I'm conducting fraud.
Yes.
My wife's gonna know about it. People close to me gonna know about it. And then next week, my wife and I getting a divorce. She wants to get even. So what she does? She calls up the authority and tell them what I'm doing. So yes, they would not investigate, but there'll be other what you call whistleblowers that will inform them. So if somebody informed them, then they will investigate. They will not come actively investigate you if you have a small loan. But does that mean that you cannot be charged for fraud if you have a $20,000 loan that is forgiven and you have no company?
Okay.
So be careful. A lot of people are getting the PPP and the EIDL loan. And I'm doing a lot of those applications, and I make sure that they have an actual company before I apply for them. Otherwise, I'm not touching it.
But the thing is, like, when you don't have a Schedule C or 1099 and you are doing your 2020 tax return, you're gonna have to provide that for 2022, right? But if you don't have it, what you gonna do?
If you don't have a Schedule C, it means you don't have any business. If you're a sole proprietor, you have to report that on Schedule C. So if you don't have a Schedule C, you don't have any business. So if those people who are having what we call transaction off the books and are not reporting it, and all of a sudden they have income, guess what happened? They're going to be questioned eventually.
Oh, okay.
And some of them are doing that. They say, oh, I have a business, but I didn't report my income. Well, you didn't report your income. Your business doesn't exist.
Yeah.
Your income is what you report to the government on your tax return. So when you apply for your PPP loan or you apply for your EIDL loan, those are the income you have to use. Don't go and bring about some fictitious numbers. And I know some people are doing that, right?
Yeah.
If you're involved with anyone applying for any of these loans, please make sure that whatever is on the paperwork is what you're reporting. And now the IRS is pulling transcript of your return to make sure that the amount you're reporting as your income agrees with Schedule C. Now, for the smaller clients, they may not do that eventually. They may not do that right away, but eventually they're going to pull that and match it up.
Okay. Thank you.
You're welcome. So as auditor, think of we working for the government that we are auditing these things. All we need to do is get a file from the IRS of everybody that's applied for the PPP loan and match the Schedule C that they report for the PPP loan or the EIDL loan with what was reported to the IRS and generate a report of those that doesn't match. And then we just have to look at those reports and send notices out. So it will take some work, but it's not that difficult to audit. Today, you'll see tax returns. The government audit a higher percentage of tax return now because of computer application. Certain things like your W-2, anything that's reported on W-2, 1099, etc., your return have to match. If it don't, they send you out a notice, hey, you owe some money. And the client will call the accountant, hey, how come the IRS send me a notice? It's because you got a 1099 that you did not report. Okay. So 75% or more of your income are verifiable, and they could verify that. Because somebody is filing a 1099 somewhere. Whether you have interest, whether you have dividends, you sold stock, there's a 1099 file. You pay mortgage interest, there's a 1098 file. Right? And the government is at a very high percentage and in a very short period, within a year and a half or two, are matching all these. If you didn't pay any mortgage interest and you claim mortgage interest on your return, within 2 years, the government will send you a notice. Hey, we don't have any record of you paying any mortgage interest. There are no 1098 that file for you. So a lot of what's being done in auditing, whether it's financial statement auditing or any other auditing, is being done electronically. A high utilization of technology. Now, there's already a course out there on utilizing technology for auditing. If you're doing a graduate studies, you could take a course that deals with technology utilization. A lot of our sampling techniques are done using audit software. If you get a job in one of the bigger firms, you're going to go through all the different softwares that you're using in the audit. So it is extremely important for every accounting major to be very technologically competent, because almost in everything that we do, we're using technology. So this COVID-19 may have is a bad thing in many ways, but in certain ways it's good because it forced every one of us to get a little more up to date with technology. Things that you weren't doing a year and a half or two ago, you're doing now. Some students was very uncomfortable taking online course. They were forced to do it. And now they are much more comfortable taking online course. Some faculty were very uncomfortable teaching online courses. Now they're all doing it. So when the transition had to be made 2 semesters ago, some of them were in chaos because they didn't know what to do. Those of us who already taught online course were well prepared to do this. Some of you students were in chaos because you never took an online course. You never took a hybrid course. So it's important that you utilize your technology skills. You're going to need it in the profession. You're going to need it in the future in almost everything you do. Today, if you look at Tesla, they're manufacturing an automobile that you don't need a driver. You could buy a Tesla car and pay $10,000 for an option where it will be driver free. It will drive for you and take you where you want. And people who have those cars, they boast about the technology, how accurate and how good it is.
Will people be comfortable? Like, will it be safe?
They already are using it. I saw some in Florida here being used. And it's safer than the human being because we will make mistakes. The car is programmed not to make mistakes. So what they're saying, I haven't, it haven't been there too long enough. But Tesla, on every one of their models now, you pay for a $10,000 option and the car will drive itself. Now think of what that will do for the future. If you have a 30 or 40 or an hour commute to your job, you get a car, the car is driving, you could be working on your way to work instead of driving a car.
I won't trust the car.
You would trust the car. When I was working, the first CPA firm I worked for, the general partner, the managing partner of that firm, had a limo, and the limo driver drives him in every day. Why? Because his commute was all the way from Suffolk County, and our office was downtown Manhattan. So it's an hour and a half commute every morning, something 2 hours. It was cheaper for him to have a limo driver and a limo driver because he was billing like about $500 an hour in those days in 1980s. So he could make $1,500 to $2,000 an hour a day working in his limo. That will pay for the limo and the driver, and he will have money left over. So it was very cost effective for him to do that. Now, most of us, if we have a limo and a limo driver, we want that for styles. No, he didn't have for styles. He have it because it makes economic sense for him to have it. Because he could make $1,500 to $2,000 on each trip coming in and out of the city by just working during that time instead of driving. In the future, maybe most of us in our commute will able to work. When I commute from Florida to New York, I used to commute every week. And people ask how I do it. Well, in the plane, I'm working. From the time I get in that plane, I'm working. I remember one February 14th, Valentine's Day, we landed at JFK and there was snow. It was only 1.5 inches or 2 inches of snow, but we were stuck in the plane for 4 hours and there's a lot of empty seats. Everybody was complaining. I just take out my computer and I start doing my work. I got 4 hours of work done while everybody was complaining for 4 hours. So sometimes we need to adapt our lifestyle to what's going on around us. Now, in auditing, you're going to see that. Now, as students and having your course online, some of you probably are not on screen. You just put the screen, so I think you're there. Well, that's okay. Play the tape somewhere along the line, okay, that you're catching up with the class. Any other questions? Well, we conclude chapter 6. Next week, we're going to do chapter 7. So in 2 weeks, you're going to have your second exam. Okay. Study hard, do well. All right. And have a wonderful day up in New York. Take care, guys.
Thank you, Professor.
Thank you.
Thank you, Professor.
Yeah. Bye for now.